traders, today we're going to be talking about understanding early assignment in options trading. Just before we start, just a quick reminder that everything discussed is for educational purposes only, is general in nature and does not take into account your personal circumstances. So in today's video, we're going to discuss an important aspect of options trading, and that is early assignment. Understanding early assignment is crucial for options traders as it can impact their trading strategies and risk management. So let's dive in and explore what early assignment is and how it can affect your option positions. So what is early assignment? Early assignment occurs when the owner of an options contract exercises it before the expiration date. This means that if you're short an options contract, either a call or a put, you may be required to fulfill your obligations as the seller of the contract before the expiration date. If you've sold a put, you could be called upon to buy 100 shares at the strike price. If you have sold a call, you could be forced to sell 100 shares at the strike price. Why does early assignment happen? Technically, an option can be assigned at any time. However, it tends to only happen when the option is in the money and there's very little time premium left. Ex-dividend dates can also impact early assignment, as some traders will exercise a call option early in order to receive the dividend payment. Let's look at some examples. Let's say Apple's trading at 171. If we've sold a 175 put and it's trading at $5.70, there is $1.70 of time premium. So the option's in the money, but there's still $170 in time premium. That means it's unlikely to be assigned early. If someone had sold the 165 call, that's trading at $8. So it's also in the money, but there's $2 of time premium. Therefore, it's unlikely to be assigned early. If someone had sold the 185 put and it's trading at $14, it's deep in the money and there's $0 of time premium left. So that is highly likely to be assigned early in this case. What are some of the risks of early assignment? The risks associated with early assignment revolve around the obligations on the option seller. If the option buyer exercises their right to buy or sell the underlying asset, the seller must fulfill their obligation. Being called upon to buy 100 shares could result in a margin call if the investor does not have the required capital. If you sell a $100 put and the stock price drops to $20, you are still required to buy the stock at 100. Early assignment and credit spreads. Let's assume you sold a 100 to 95 bull put spread and the stock has dropped to 90 near expiration. So both of those puts are in the money. If you're assigned on the $100 put, you can exercise your right and exercise your $95 put. The two offset and you're left with 0 shares. Where it gets tricky is if the stock is trading between 95 and 100 near expiration, so in between the two strikes. For example, if you get assigned on the $100 put and the stock is trading at 97, you're going to have to buy the 100 shares, but because it's your $95 put that you own is still out of the money, you're not going to exercise that. So you're then going to have to sell the shares in the market and then close out the long put. So it's a little bit trickier, just something that you do need to be aware of. Avoiding early assignment. While it may not be possible to avoid options assignment completely, there are several strategies that option traders can use to reduce the likelihood of being assigned. Consider closing or adjusting a short option before it goes in the money. You can roll to a lower or higher strike or even roll out in time. Covered calls and early assignment. When your covered call gets assigned, it means that the buyer of the call option has exercised their right to buy the underlying stock from you at the strike price. As the seller of the call option, you are obligated to sell the stock at the agreed upon price, regardless of its current market value. While being assigned on a covered call position can result in selling your stock, it generally means you have made a profit on the trade. After assignment, you are free to buy back the stock at the market price and consider entering new covered call positions if you still believe in the stock's potential. Being assigned on a covered call could result in additional tax obligations. automatic assignment. If you're an option seller, your option will either be exercised by the buyer or automatically assigned if it is in the money on the expiration date. If you're an option buyer, your option will not be automatically assigned before expiration. However, most brokers will automatically assign in the monies on the expiration date. So in conclusion, early assignment is a risk that all option traders should be aware of and be prepared to manage. By understanding what early assignment is, why it happens, and how to mitigate its risks, traders can navigate the options market more effectively and protect their portfolios. As always, proper risk management and ongoing education are key to successful option trading. Thanks for watching and happy trading.